10. Day trading tips for beginners. Day trading is the act of buying and selling a financial instrument within the same day or even multiple times over the course of a day. Taking advantage of small price moves can be a lucrative game if it is played correctly. Yet it can be dangerous for beginners and anyone else who doesn't adhere to a well thought out strategy. Not all brokers are suited for high volume trade generates. On the other hand, some fit perfectly with day traders. Some key takeaways before we get started. Day trading is only profitable in the long run when traders take it seriously and do their research. Day traders must be diligent, focused, objective, and unemotional in their work. Day traders often look at the liquidity, volatility, and volume when deciding what stocks to buy. Some tools that day traders use to pinpoint buying points include candlestick chart patterns, trend lines, and triangles, and volumes. Number 1, knowledge is power. In addition to knowledge of day trading procedures, day traders need to keep up with the latest stock market news and events that affect stocks. This can include the Federal Reserve System interest rate plans, leading indicator announcements, and other economic, business, and financial news. So do your homework. Make a wish list of stocks you like to trade. Keep yourself informed about the selected companies, their stocks, and general markets. Scan business news and bookmark reliable online news outlets. Number 2, set aside funds. Access and commit to the amount of capital you're willing to risk on each trade. Many successful day traders risk less than 1 to 2% of their accounts per trade. If you have a $40,000 trading account and are willing to risk 0.05% of your capital on each trade, your maximum loss per trade is $200. 0.5% times 40,000. Earmark a surplus amount of funds you can trade with and are prepared to lose. Number 3, set aside time. Day trading requires your time and attention. In fact, you'll need to give up most of your day. Don't consider it you have limited time to spare. Day trading requires a trader to track the markets and spot opportunities that can arise at any time. During trading hours, being aware and moving quickly are key. 4, start small. As a beginner, focus on a maximum of 1 to 2 stocks during a session. Tracking and finding opportunity is easier with just a few stocks. Recently, it's become increasingly common to trade fractional shares. That lets you specify a smaller dollar amount that you wish to invest. This means if Amazon shares are trading at $3,400, many brokers now let you purchase a fractional share for the amount that can be as low as $25 or less than 1% of the full Amazon price. Avoid penny stocks. You're probably looking for deals in low prices, but stay away from penny stocks. These stocks are often illiquid and the chances of hitting the jackpot within them are often bleak. Many stock trading under $5 a share become delisted from major stock exchanges and are only tradable over-the-counter OTC. Unless you see a real opportunity and have done your research, steer clear of these. 6, time those trades. Many orders placed by investors and traders begin to execute as soon as the markets open in the morning, which contribute to price volatility. A seasoned player may be able to recognize patterns at the open and time orders to make profits. For beginners, though, it may be better to read the market without making any moves for the first 15 to 20 minutes. The middle hours are usually less volatile, then movement begins to pick up again toward the closing bell. Though the rush hour offer opportunities, it's safer for beginners to avoid them at first. Number 7, cut losses with limit orders. Decide what type of orders you'll use to enter and exit trades. Will you see market orders or limit orders? A market order is executed at the best price available at the time with no price guarantees. It's useful when you just want in or out of the market and don't care about getting filled at a specific price. A limit order guarantees price but not the execution. Limit orders can help you trade with more precision and confidence because you set the price at which your orders should be executed. A limit order can cut your losses on reversals. However, if the market doesn't reach your price, your order won't be filled and you'll maintain your position. More sophisticated and experienced day traders may employ the use of option strategies to hedge their positions as well. 8. Be realistic about profits. A strategy doesn't need to succeed all the time to be profitable. Many successful traders may only make profits on 50 to 60% of their trades. However, they make sure the winners then they lose on their losers. Make sure the financial risk on each trade is limited to a specific percentage of your account and the entry and exit methods are clearly defined. 9. Stay cool. There are times when the stock market tests your nerves. As a day trader, you need to learn to keep greed, hope, and fear at bay. Decisions should be governed by logic and not emotion. Number 10, stick to the plan. Successful traders have to move fast, but they don't have to think fast. Why? Because they develop a trading strategy in advance along with their discipline to stick to it. It is important to follow your formula closely rather than to try to chase profits. Don't let your emotions get the best of you and make you abandon your strategy. Bear in mind mantra of day traders: plan your trade and trade your plan. What makes day trading difficult? Day trading takes a lot of practice and know-how, and there are several factors that can be made challenging. First, know that you're going up against professionals and whose careers revolve around trading. These people have access to the best technology and connections in the industry. That means they're set up to succeed in the end. If you jump on the bandwagon, it usually means more profits for them. Next, understand that Uncle Sam will want a cut of your profits no matter how slim. Remember that you'll have to pay taxes on any short-term gains investments that you hold for 1 year or less at the marginal rate. And upside is your losses will offset any gains. Also, as a beginning day trader, you may be prone to emotional and psychological biases that affect your trading. For instance, when your capital is involved and you're losing money on a trade, experienced, skilled professional traders with deep pockets are usually able to surmount these challenges. Deciding what and when to buy. What to buy. Day traders try to make money by exploiting minute price movements in individual assets, stocks, currencies, futures, and options. They usually leverage large amounts of capital to do so. In deciding what to buy a stock, say a typical day trader looks for 3 things. Liquidity. A security that liquid allows you to buy and sell it easily and hopefully at a good price. Liquidity is an advantage with tight spreads or the difference between the bid and ask price of a stock, and for low slippage or the difference between the expected price of a trade and the actual price. Volatility. This is the measure of the daily price range, the range in which a day trader operates. More volatility means greater potential for profit or loss. Trading volume. This is the measure of number of times a stock is bought and sold in a given time period. It is commonly known as the average daily price volume. A high degree of volume indicates a lot of interest in a stock. An increase in a stock's volume is often a harbinage of a price jump, either up or down. When to buy. Once you know the stocks or other assets you want to trade, you need to identify entry points for your trades. Tools that can help you do this include real-time news services. News moves stocks, so it's important to subscribe to services that alert you when potential market-moving news breaks. ECN Level 2 quotes. ECNs, or electronic communications networks, are computer-based systems that display the best available bid and ask quotes from multiple market participants and then automatically match and execute orders. Level 2 is a subscription-based service that provides real-time access to a NASDAQ order book. The NASDAQ order book has price quotes from the market makers in every NASDAQ listed in OTC bulletin board security. Together, they can give you a sense of orders executed in real time. Intraday candlestick charts. Candlesticks provides a raw analysis of price actions. Define and write down the specific conditions in which you'll enter positions. For instance, buy during an uptrend isn't specific enough. Instead, try something more specific and testable. Buy when the price breaks above the upper trend line of a triangle pattern where the triangle is preceding by an uptrend at least one higher swing and higher swing low before the triangle form on the 2-minute chart in the first 2 hours of the trading day. Once you have a specific set of entry rules, scan more charts to see if your conditions are generated for each day. For an instance, determining whether a candlestick chart pattern signals price moves in the direction you anticipate. If so, have a potential entry point for strategy. Next, you'll need to determine how to exit your trades. Deciding when to sell. There are multiple ways to exit a winning position, including a trailing stop and profit targets. Profit targets are the most common exit method. They refer to taking a profit at a predetermined price level. Some common profit target strategies are scalping. It's one of the most popular strategies. It involves selling almost immediately after a trade becomes profitable. The price target is whatever figure means that you'll make money on the trade. Fading. Fading involves shorting stocks after rapid moves upward. This is based on the assumption that 1. They are overbought, 2. Early buyers are ready to profits, and 3. Exiting buyers may be scared away. Although risky, this strategy can be extremely rewarding. Here the price targets is when the buyers begin stepping in again. Daily pivots. The strategy involves profiting from a stock's daily volatility. You attempt to buy at the low of the day and sell at the high of the day. Here the price target is simply the next sign of reversal. Momentum. This strategy usually involves trading on news releases or finding trending moves supported by high volumes. One type of momentum trader will buy on the news releases and ride a trend until it exhibits signs of reversal. Another type will fade this price surge. Here are the price targets when volume begins to decrease. In many cases, you will want to sell an asset when there is a decreased interest in the stocks, as indicated by the ECN level 2 in volume. The profit target should also allow for more money to be made on winning trades than it is on losing trades. If your stop loss is 0.05 away from your entry price, your target should be more than 0.05 away. Just as your entry points define exactly how you will exit trades before you enter them. The exit criteria must be specific enough to be repeatable and testable. Day trading charts and patterns. 3 common tools day traders use to help determine the opportunity of buying tradings are candlestick chart patterns, including engulfing candles and dojis. Other technical analysis, including trend lines and triangles. Volume. There are many candlestick steps a day trader can look for to find an entry point. If followed properly, the doji reversal highlighted in the yellow charts is one of the most reliable ones. Also, look for signs that confirm the pattern. A spike on the doji candles or candles immediately following it, which can indicate the traders are supporting the price at this level. Prior supporting this level, such as prior low of the day or the high of the day. Level 2 activity, which will show all open orders and order sizes. If you use these confirmation styles, you may determine whether or not the doji is signaling an actual turnaround and a potential entry point. Chart patterns also provide targets for exit. For example, the height of a triangle at the widest part is added to the breakout point of a triangle for an upside breakout, providing a price to which take profits. How to limit losses when day trading. Stop loss orders. It is important to find exactly how you limit your trade risk. A stop loss order is designed to limit losses on a position in security. For long positions, a stop loss can be placed below a recent low. For short positions, above a recent high. It can also be based on volatility. For example, if a stock price is moving above at 0.05 a minute, then you might place a stop loss order at 0.5 away from your entry to give the price some space to fluctuate before it moves in your anticipated direction. In the case of triangle patterns, a stop loss order can be placed at 0.02 below a recent swing low if buying a breakout, or 0.0 below the pattern. You could also set 2 stop loss orders. Place an actual stop loss at the price that suits your risk tolerance. Essentially, this level would represent the most money that you can stand to lose. Set a mental stop loss orders at the point where your entry criteria would be violated if the trade takes an unexpected turn. You'll immediately exit your position. However, you'll decide to exit your trades that exist criteria must be specified enough to be testable and repeatable. Set a financial loss limit. It's smart to set a financial loss limit per day you can afford. Whenever you hit this point, exit your trade and take the rest of the day off. Stick to the plan. After all, tomorrow is another day. Test your strategy. You are defined on how you enter trades and where you'll place a stop loss order. Now you can access whether the potential strategy fits within your risk limit. If the strategy exposes you too much risk, you need to alter it in some way to reduce the risk. If the strategy is within your risk limit, the testing begins. Manually go through historical charts to find entry points that match yours. Note whether your stop loss order or price target would have been hit. Paper trade in this way at least 50 to 100 trades. Determine whether the strategy would have been profitable and if the result meets your expectations. If your strategy works, proceed to trading in a demo account in real time. If you take profits over a course of 2 months or more simulated environment, proceed with the day trading with real capital. If the strategy isn't profitable, start over. Finally, keep in mind if you trade on margin, you can be far more vulnerable to the sharp price movements. Trading on margin means borrowing your investment funds from a beginning brokerage firm. It requires you to add funds to your account at the end of the day if your trade goes against you. Therefore, using stop loss orders is crucial when day trading on margin. Basic day trading techniques. Now you know some of the ins and outs of day trading. Let's review some of the key techniques new day traders can use. Whether you master techniques, develop your own personal trading styles, and determine what your end goals are and how you use a series of strategies to help you in the quest for profit. Although some of the techniques were mentioned above, they are worth into again. Following a trend. Anyone who follows the trend will buy when prices are rising or short sell when they drop. This is done on the assumption that prices that have been rising or falling steadily will continue to do so. Contrary investing. This strategy assumes a risk and price will reverse and drop. The contrary buys during a fall or short sells during a rise with the express expectation the trend will change. Scalping. This is a style by what a spectator exploits a smaller price gaps created by the bid-ask. This technique normally involves entering and exiting a position quickly, within minutes or even seconds. Trading the news. Investors using this strategy will buy when good news is announced or short sell when there's bad news. This can lead to a greater volatility, which can lead to higher profits or losses. Which trading strategy is easy for a beginner? Following trend is probably an easy trading strategy for a beginner based on the premise that the trend is your friend. Contrary investing refers to going against the market hard. You short a stock when the market is rising to buy it when the market is falling. This may be a difficult trading technique for a beginner. Scalping and trading news requires a presence of mind and rapid decision making that again may pose difficulties for a beginner. Is day trading good for beginners? Most day traders will end up losing money, at least according to data, but with experience your chance of succeeding can grow. Beginning traders should use trade accounts with paper money or fake trades before they invest their own capital in order to learn the ropes, test out strategy, and employ the tips above. If technical analysis or fundamental more appropriate for day trading. Technical analysis can be more appropriate for day trading. That's because it can help trader to identify the short-term trading strategies and trends that are essentially for day trading. Fundamental analysis is better suited for long-term investing as it focuses on evaluation, the difference between an asset's actual price and its intrinsic value as determined by a fundamental analysis may last for months, if not years. Market reaction to fundamental data like news or earning reports is also quite unpredictable in the short term. That said, market reaction to such fundamental data should be monitored by day trades for trading opportunities that can be exploited using technical analysis. Why is it difficult to make money consistently from day trading? Making money consistently from day trading requires a combination of many skills and attributes: knowledge, experience, discipline, mental fortitude, and trading acumen. It's not always easy for beginners to implement basic strategies like cutting losses or letting profits run. What's more, it's difficult to stick to one trading discipline in the face of challenges such as market volatility or significant losses. Finally, day trading involves putting wits with millions of market pros who have access to cutting-edge technology, a wealth of experience and expertise, and very deep pockets. That's no easy task when everyone is trying to exploit inefficiencies in an efficient market. Should a day trading position be held overnight? A day trader may wish to hold a position overnight, either reduce losses on a poor trade or to increase profits on a winning trade. Generally, this is not a good idea if a trader simply wants to avoid booking a loss on a bad trade. Risk involved in holding a day trade position overnight may include having to meet margin requirements, additional borrowing costs, and the potential impact of negative news. The risk involved in a holding position overnight could outweigh the possibility of favorable outcome. The bottom line: day trading is difficult to master. It requires time, skill, and discipline. Many who try it lose money, but the strategy techniques described above may help you create a potential profitable strategy. Day traders, both institutional and individual, play an important role in the marketplace by keeping the markets efficient and liquid. With enough experience, skill building, and consistent performance evaluation, you may be able to improve your chances of trading profitability. You know the catchphrase: study it, analyze it, adapt it. Peace.